Let's bring in Melissa Brown, Qontigo, Managing Director of Applied Research. Thank you so much for being here. So we've talked a lot about the risks that aren't so hidden, namely bond yields moving higher. What do you think investors should be paying attention to here?
Well, I think in general, investor sentiment is not good, and you see that in the performance of Alphabet today. They reported bad news and just got crushed for it. So I think the risk is in mildly bad news creating a big negative reaction, and if that starts to spread out across more stocks, I think overall that's not good for the stock market.
And Melissa, I know you're tracking sentiment. What about trading volume? Did that recover from the summer lull here?
No, it's interesting that trading volume has remained quite low. It's well below where it was during the summer. And, we view that as being an indication that investors may not actually know what to do. Do I buy bonds? Do I not buy bonds? Do I buy certain kinds of stocks? Do I go into the Magnificent Seven, or retreat from them? And I think all of that has created kind of a paralysis. So investors don't know what to do, so they're not doing much of anything. And we see that in the volume numbers.
Speaking of paralysis, Washington, D.C. It has been an example of it as of late. But it looks like now that, as we talked about earlier, that there could be a Speaker of the House, and that it looks like it's Mike Johnson of Louisiana, who is towards the right of the GOP. Are there implications for investors here, namely when it comes to government shutdown, for example?
Well, I think on the one hand, there's good news in that there's been an uncertainty lifted. It was not clear how long we were going to go without a speaker, and at least we have that uncertainty lifted. On the other hand, it might be replaced by a different uncertainty about whether the government is going to shut down. And really what's going to happen with spending and so on. So, I think it's kind of a good news, bad news situation that we have at least found a speaker.
And Melissa, I'm interested, given all these different cross currents, so the drama in D.C. and earnings, geopolitical risk, still seeing a relatively low level of volatility. What explains that, do you think?
Well, I'm not sure I know exactly what explains it. Until recently, we had many stocks that were kind of, moving. You had the Magnificent Seven, then you had, other stocks. They were not necessarily moving in the same direction. So low correlation between stocks tends to drive volatility down. But it's not clear to me. Correlations have gone up and volatility has still stayed relatively muted. We think that, there might be a false flag there that, investors are perhaps getting a false sense of security by this low volatility. But then we see some, bad news comes out, the already negative sentiment starts to kick in. And then, you have everybody heading for the doors because it doesn't look like they've been expecting this bad news that that may be coming out, and so that's a big concern. In general, low volatility can be considered to be good, but it's not always good. And in fact, before other market peaks, it has been relatively low.
So, Melissa, does that imply here that investors need to get more defensive, or they need to hedge their more bullish positions in case of more negative surprises?
I think that certainly caution is in order. We want to continue to watch as earnings are coming out and see what the reactions are. But in general, and I tend to be relatively cautious anyway, but I think that taking a more cautious stance, perhaps by hedging, perhaps by just, kind of moving from riskier stocks to less risky stocks, or moving from stocks to bonds, it doesn't seem like that is going to be a terrible call, given this kind of environment.
And given this kind of environment, we just talked about the NASDAQ now entering correction. It looks like it's going to close there down 10% from its recent high. Do you see more downside from here?
Well, I mean, we are looking at pretty high valuations, which is another potential issue. If stocks are cheap and their earnings are a little bit disappointing, that's generally not a big problem. But if PE ratios are high, first of all, it's more likely that bad news is going to trigger that decline, and the higher the PE, the higher the decline potentially could be. And so I wouldn't say that every time we cross that 10% threshold, we always get another 10% or say, but I think certainly all the building blocks are in place that it could continue to go down.
All right, we shall see. Melissa Brown, Qontigo Managing Director of Applied Research, thanks for your time. Appreciate it.